Hello, 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 everyone. Welcome. We are so thrilled that you are here today because we have our very special guest, Danny Flores, who's been a multifamily investor for years and years. Gee, Danny, I don't know how far back we go, but it's got to be more than we want to say, right?
It's been a while. It's been a
We're both
while.
getting this color here.
Yeah,
And we
we
met
are.
when we were our own natural blondes. So
Uh-huh.
so as you know, as the nest egg builder, one, we have a book that just came out to teach people how money works. It's the basics of money. So you can buy it for 20 bucks on Amazon and read it to your children. And if your children are old enough to read, have your children read it to you, which will make a huge impact. They'll be able to ask you questions. It's a great book, gotten a lot of compliments on it, and we're headed towards the bestseller list, one book at a time. So we do that, and then we also have what's called the Ultimate Investment Protection System, which is just a 1 day course, and it teaches people who would like to be investors. It doesn't matter what they want to invest in how to do your due diligence. So we go through putting a due diligence list together, have you ask the questions. Does it matter if you want to be in real estate, a passive investor, active investor, stock market? Well, we have people we can refer you to, but we want you to know the right questions to ask before you give anyone your hard-earned money. So if you're interested in that, let me know. Let's set up a little chat. It's just a 1 day course. It's like 449. That's $449, not $4.49. Right. So anyway, I have 40 years of experience of investing, and uh, that's what I love about Danny coming on. He's got that too. So before we start with Danny and his wonderful background as a real estate and not just the investor, but he's the syndicator who goes out and finds the property, fixes them up, adds value to it, creates cash flow for you, gives you lots of tax write-offs, and helps you with your depreciation and things that will write off against your taxes. I just wanted to read this quote that I thought was very fitting. This is from Franklin D. Roosevelt. He was the 32nd president of the United States. It's real estate cannot be lost or stolen, nor can it be carried away. Purchased with common sense, paid for in full, and managed with reasonable care, it is about the safest investment in the world. And working with Danny is also a safe investment. You can hold me to that. Danny,
Thank you, Peggy.
we're
Thank you,
so glad
Peggy.
to have you here. We know you're here in California, but you purchase all over well, you don't actually purchase all over the United States, but you have a few places you really like to work. So maybe you can
Yes.
tell a little bit about your background and then why you pick the places you do pick, and then talk about what you have right now.
Yes, yes. Thank you, Peggy. Thank you so much for having me on here, and thank you for the kind introduction. Yes, I am. I have been in the business for a while, and I have a unique experience and skill set bringing in the business because my first career was in construction. So I was actually a builder for the first 16 years of my career, and I started very young when I was about 19, 20 years old. I was a builder. Then I decided that I wanted to go back to school and change careers. I was able to get into USC, got a corporate finance degree, and became a banker. So that was really cool. It was really interesting.
Mm.
I retired out on a Friday, and Monday I start in my new job in banking. And now I went from, jeans and t-shirt and boots and hard hat and all dirty to coming in an office in slacks and nice shirt and pants. So it was night and day. Nevertheless, it was a great transition doing that because we did loans between 25 million to over $1 billion. So that's where I kind of cut my teeth on the finance side of it, structuring the loans, structuring the covenants, the reporting requirements, and meeting clients and just learning about that. But my true passion was to be able to buy multifamily. That's what I wanted. I wanted multifamily. because I knew that when you buy the asset doesn't go away, your principal doesn't go away. It actually appreciates over time. The cash flow increases, and the mortgage, with the right mortgage, stays stable. So your cash flow will increase, and it can give you cash flow for many years. So it's a great retirement tool, is the way I looked at it. So I bought my first fourplex in the year 2000. So I've been doing this for 25 years. I bought a fourplex. I saved $65,000. I was able to go in there and buy it. A year and a half later, I sold it for $100,000 profit. And how fast, where else can you make that kind of money that fast, right? That's the other beauty of this asset. Plus, you have the tax benefits that go along with it at the same time. So I was able to buy it. And so what I did for the next 15 years, I did 1031 exchanges, held the property a handful of years and bought some more, tried to save some more. I bought what I could with my own money. And in 2006, I started a property management company, LA County, Orange County, and I grew that business where I was able to sell that business about 4 years ago. I decided to exit the business because just California is just too tough to operate as an operator, as a landlord, with all the regulations. I had discovered that other states are easy to operate, and you can just hop on a plane and just build out operations somewhere else. And having the construction background, having the property management background, having the banking background made it easy for me to be able to do that. Build out teams that would be able to manage our properties, be able to do our renovations. And so currently we are in Arizona. We had some partnerships in Florida and Texas, and then we're also in North Carolina, but primarily active in Arizona. We've been buying there. We continue to buy there. We think it's the bottom of the market right now, and we continue to find good deals because we've established good broker relationships. And all the deals that we buy now are basically off-market deals. So there's no competition where the prices are bid up, that we just basically get that call and say, hey, we have this deal. They want X amount of dollars for it. We'll underwrite it, and if it makes sense, we'll go out and we'll buy it. So that's kind of pretty much in a nutshell my background and how I ended up here and doing these larger syndicated deals. It was about 2018, 2019, where I hired a coach to learn to be able to raise money for these deals. And that's the tricky part, right? The operations, the property management, the renovations, I had that down. It's just like, how do we raise money? How do we reach investors? How do we provide investors with great returns? What do those deals look like? And we learned and been doing that since and been able to grow the portfolio. I think we have about 1,800 units or so right now.
Mhm.
And we're just growing. We're growing growing in acquisitions and our network and our ability to bring in investors and get these deals done.
And how many investors do you have right now, would you say?
Oh, Corey, that's a trick question because
Okay.
that one I couldn't answer, but we've done JV partnerships, we've
Oh,
used institutional capital, we've used retail investors. We actually have a deal right now that we're actually doing accredited investors simultaneously with crowdfund. I think crowdfund was started last year. And what that allows is when you go out and you raise money from accredited investors, you kind of leave everybody else out of the deal because they don't qualify if they don't have the net worth requirements. With crowdfund, you can actually go out and market to everybody, and you can bring in investments as small as $5,000, and you don't have to be accredited. And so with that, raising simultaneously with the accredited and a crowdfund, you're able to basically cover everybody, and nobody has to stand on the sideline because they don't qualify.
did you hear about this other funding? You still close with your accredited investors, but then they could sell portions of or they could sell all of their interest in their position to non-accredited investors. Have you heard about this?
That I have not.
Okay,
No.
I'm going to introduce you to those people because I think that you would be very interested in that.
Okay. Yeah, no, I appreciate that. Yeah, because you're always looking for ways to be able to bring these investments to everybody,
Sure.
right? Everybody wants a chance to be able to grow wealth or to set themselves up a little bit better, potentially for retirement and whatnot. And if you don't have a lot of money, you're kind of out usually of these deals.
Right.
This way you can get in. You can get in, whether it's like what you're talking about or what we're doing is crowdfund. You can get in the deal. You don't have that much money, but you know what? Everybody can get started, and your money will grow from there.
Absolutely. And right now, there's a lot of people that have Roth IRAs or self-directed IRAs,
Yes,
traditional one, which they could flip into the Roth, and they don't have that money invested. For some reason, they think that it's growing. One, they think it's growing while it's sitting in their self-directed IRA. And the other is they think it's tax-free when it's in a traditional and it's not tax-free. So
correct.
that all that education really needs to get out there. We need, and I'm doing everything I can to educate as many people that want to, that are
That's
interested
great.
in being educated.
Yeah, that's a great thing you're doing,
Yeah,
Peggy.
this book, if you read this book, I mean, one or two of the chapters are about Roth versus traditional and
Right.
401ks and explaining all of that.
Yeah. No, no, that's great.
Yeah, so what do you have? You said you've got something right now.
Yeah, yeah. I mean, I'm happy to share. Let me share my screen
Yeah, share it.
and then I'll do a
And
little
then if you give,
presentation.
yeah, and give the crowdfunding of, just put that in the chat or let me have it some way so I could I'd be happy to send our investors to that so they could get in. Because a lot of them
Yeah.
don't have money and they would like to invest. That's why they're part of our group.
Oh, hang on a second. There we go. All right. Can you guys see that?
West Side Commons.
Yes, yes, yes. Okay. So I have a uh 84 unit deal under contract in Tucson, and this was sourced to us off market by the broker, and it's a group out of Chicago that went in, and in 2021 their business plan was to build a portfolio in Tucson. They ended up buying this deal. They bought another one. They renovated them. But when the interest rates rose in 2021, 2022, everybody kind of inventory dried up and they weren't able to execute on their business plan. Nevertheless, long story short, they decided to sell, and I was lucky enough to be able to get in and buy it. We haven't closed. We're closing this week. We're closing escrow on it this week. Just a quick disclaimer about what we're doing is this is a presentation, not an offering. The offering is done through a PPM, which is on our website, on our investor portal. And then the second big one is that we have projections. Our projections are not guaranteed, but they are based on our experience and our knowledge in the current market. We've been in the business for 25 years buying multifamily. I'm the principal of Prime Capital Investments, and we continue to buy in the Arizona market. This is for us, this is the seventh deal that we buy in Arizona, in Tucson specifically. Out of those seven, we've already exited on three, all of them on a 5-year plan, and we were able to exit with our 5-year earnings and for or exceeding our forecast in 2 to 2.5 years. So we like the market. We have our teams built there already, and we know what the investors want. So that's how we pick the deals that we buy. Eddie Simmons. Right? You have to know your market, and we've had success in it, so we continue to buy there. So I'm the principal of Prime Capital Investments. We also have a CFO, Crystal D. Joseph, and then I also co-sponsor, brought in a co-sponsor, Hitomi Yasuda, on this particular deal. Now we are hiring our property management company there is North Star. North Star is headquartered in the Tucson market. That's their main market. They currently manage three of our other buildings. We have a relationship with them. We like how they manage. They have about 4,000 units under management, and they've been in the management business for over 30 years. I have a case study here, and this is a building that we bought in 2021 out in Tempe, an 88 unit building. We bought it off market as well. We went in and we did full renovations on 80 of the 88 units, and that entailed all new interiors, new countertops, new cabinets, stainless steel appliances, light fixtures, flooring, paint, and including washers and dryers in that building. So we did that to 80 of the 88 units, and we were able to do those renovations in 12 months flat. So we do these super fast. We have a really good construction team out there that we contract, and we have a great management company that helps us do that, accomplish that. We were able to more than double the net operating income on this building from when we acquired it a year later to be able to do that, and it continues. We still own it. It continues to operate at a 92 to 95, 96, 97% occupancy. We did such a great job on it that we were nominated for the Tribute Awards. We made it all the way to the finalists, but we didn't end up winning on that. Second case study here is a 150 unit building that we have in Phoenix. Once again, we were able to get this one off market. The owner, bought it for 24 million. The owner carried 14 million of that, the original note. We raised the money for the rest. We raised the CapEx money on this one because at that time, bridge loans wouldn't work on the deal. We renovated all 150 units, all new countertops, same business plan as the other one, the new cabinets, the appliances, all stainless steel appliances, the bathrooms, paint, interiors. We painted the exterior. We replastered the pool, and we finished the renovations on this building in 17 months flat, all 150 units, and we only went $8,000 over our $3.5 million budget. So we're really good on staying on budget and actually beating expectations and projections on time because we figured we'd get this done in 2 years, so 24 months. We did it in 17. And what happens when you do that is you're able to move that NOI higher, quicker, and kind of makes your projections look better in that sense to be able to do that at a faster pace.
Was that vacant that you could do that so
No,
fast?
no, no.
How'd you work with all the people?
What we did is we did it in batches. And we work really close with our construction team, really close with our property management team. We created a schedule of batches for the entire build out and renovation for 17 months. When we originally started, we figured our initial renovation plan was to do 12 units every 4 weeks. So what happened was we had such a great leasing team out there that when we were done with that batch of 12, they were all 100% pre-leased. So
Wow.
they were getting the units and we're moving people in. So that to me signals that we're going too slow. So I had talked to our contractor and I said, Mr. Contractor, I says, we need to increase the tempo here. Can you do 16 units in 4 weeks? He goes, no, not in 4 weeks, but I can do 16 in 5. I said, okay, I'll take that. So
Yeah.
now we increased the speed, and we had such a great leasing team that we were able to basically have them pre-leased upon completion. However, the contractor wasn't, we don't want to increase him because now it's a little harder to pick up the tempo from 16 to 20. But what they did is they were able to move the tenants around and get units because we had a commitment to the contractor to be able to keep that schedule. We had to give him his batch of 16 by certain dates. So we
Mhm.
had to have him empty. Luckily enough, because we had such a great management team that we were able to keep about 83% of the existing tenants.
Wow.
So it became easier where we're just moving kind of tenants from their units to the new units. As fast as we're getting them, we're moving them. And so that helped with the lease up to be able to stabilize the building so much quicker because we didn't have to go out to market and bring all new tenants in. And the reason why, and we did ask that, I'd like to listen to the tenants and ask them what are we doing right? And they said it was a customer service with our leasing team and our property management team that they were able to follow up. They were very accommodating, and that's the reason why they were able to keep them. And also that's what kept them in the building because they liked the community, they liked the other tenants, and they liked the management team there as well.
Wow. Congratulations. That's amazing. You rarely hear a story like that.
Right, right. Thank you, thank you. Yeah, so that's being able to the skill set is what I bring to the table to operate at such efficiency. Now on that building, we just did a refinance, and we were able to pay the the owner, the old owner, his loan back, and we were able to give 2 million back to investors as well. So we were able to pay back one class of shares. Investors are always happy to get their money back, so
Yeah.
we're happy to be able to do that. And so that was pretty good. And we
Great.
start distributions and everything that investors like we're producing.
Yeah, how long does that usually take? So it took you 17 months, so there's no cash flow coming on the 17 during that 17 month. And then when
Right. Well, we did have a class of shares that they were structured kind of like pref equity, so we were able to give them their distribution on a quarterly basis. But for the common shareholders, no, there was no distributions during that time. So now we've paid out that class of shares and any accrued interest, and so they're done. And now we're concentrating on distributing to the common shareholders now. So
okay. And
that's
how long did
that's
that take totally before the
it took
comment?
us about 2.5 years or
Okay.
so to get there,
And
which
they
is
knew that
typical
going in.
renovation.
And
Pardon?
they knew that there would be no cash flow for 2.5 years
Oh yeah,
approximately.
yeah, yeah. But see now the mindset shifted of investor mindset shifted a little bit. Investors want cash flow.
Yep.
So
So,
deals like this are harder to do now because it's harder to raise money and bring investors to them. So you have to understand what the investors want. So you buy the kind of deals that the investors like.
right. So the one you're looking at now is already rehabbed.
Already rehab. There's no renovation risk with all the tariffs going on about your material supplies running through the roof or being able to get them because they're stuck at their harbor or they just can't ship them out. That's done. So it's pure getting in here and tweaking the operations, and it cash flows right out of the gate.
That's great. And when you say that, is that like a quarter after you close,
Yes,
something like
yes.
that?
So we'll
That's
close. We're closing this week. So Q2, Q3, we'll be able to start distributions.
okay. Yeah, people need to know that because when you say out of the gate, they think, oh, you're closing tomorrow. I'll get a check on the first of the month.
Right, right. No, thank you for
Oh,
clarifying that. Yes, yes. So
doesn't
after the
work that
first full
way,
quarter,
investors. Yeah.
yeah,
Okay,
yeah.
good. So what are your plans for this property then, if it's already cash flowing?
Well, let me go through here,
Yep.
and then we'll answer that question.
Okay, good.
Um, Okay, so here's our transaction history of being in the business. We've purchased 31 properties. We've had 18 successful exits. Been doing it since 99, 2000, and we've done over $100 million of transactional volume. Our investor reporting is done on a quarterly basis, as well as our distributions are done on a quarterly basis. The deal. Okay, here's what the deal looks like. Okay, 84 units. It's fully renovated already. And I do want to say we also rate locked already on our loan, and our lender is going to finance 76.5% LTV with a 5.4% interest rate on the loan. So we got really good terms on the loan. They like the building a lot. Okay, we're buying it for 10.75. It's 84 units. We have occupancy hovering between 94 and 95%, and the whole period is 5 years. Our targeted IRR on this deal is set a little over 17%, equity multiple close to 2x, and an average cash on cash of 9%, a little over 9%. Here's what the building looks like, Ariel. It's kind of, it has a street going down the middle, so it's almost like two separate properties making up the whole complex. On the right side is a leasing office. On the left side is a pool. Both sides have laundry rooms. When they did the renovation on the two bedrooms, they were able to install washers and dryers, but they didn't do it on the one bedrooms. Here's what the picture looks like. Interior is renovated. And then to answer your question, Peggy, what are we doing since it's renovated? So we're basically taking over like if we had renovated and then we come back and we stabilize it. We're changing the property management company out. We're putting ours in. The current property management company tends to run the rents a little bit low, and also they tend to run expenses a little bit high, especially payroll. Putting our property management in, we're going to do slight rent increases, not big ones yet because the market doesn't allow for that, but we're also going to be able to reduce operational expenses. And then we also plan on being able to add a supplemental loan on year three uh, because of the operations and the cash flow. And once we do that, we plan on doing that to be able to give investors some of their money back. We have three classes of shares, and this is on the accredited investor side of it. We have a minimum. The minimum is 75,000 on Class A. Class A has a 12% return on your money total, no upside on the deal. And how we structured this is we're going to pay 6% current pay, which means on an annual basis, we'll pay out 6%. The other 6% will accrue on a capital event, which is the sale at the end. We'll pay out to the investors any unpaid interest and then give the capital back. Class B, 75,000 minimum as well. That's common equity coming in with an 8% preferred return. Then we go to a 70-30 split. Once we accomplish a 15% IRR, then we go to a 60-40 split. And on the preferred return, if you guys don't understand that, it's 8% that's paid out on an annual basis before any of the profit gets split between the general partners and the limited partners. And the limited partners, in this case of the split, can get 70% of the profit pro rata based on your investment. Then we have Class C. And so if somebody comes in with a larger check size, they do get a little bit better economics, a 9% preferred return, and then an 80-20 split. Now, on the crowd fund side of it,
Yeah.
it's for somebody who doesn't have a lot of money. We have a Class D shares for that. The minimum investment there is 5,000. The economics on this are a little bit less because obviously the amount coming in is a lot less. This is 6% preferred return. Then we go to a 60-40 split up to a 12% IRR. And then once we hit a 12% IRR, then it's a 50-50 split.
Who does all your bookkeeping? That's a lot of bookkeeping to track.
Well, that's why we have the CFO to be able to do that for us and build our models and track all of that. So we've been doing it for a long time, Peggy. We got it kind of dialed down where it's pretty easy, I'd say. It is still work, but it's just wash, rinse, and repeat what we've done before. So here's an illustration on the Class A shareholders of what it looks like. Say you come in with $100,000. We will be cash flowing $6,000 a year on that. And then you have the return that shows, hang on a second, that shows, you can see it on the right side of year five, 50,400. It's a total payout on $100,000 for that return. So it ends up being a total payback 100,000 plus the 50,400 that we pay out for a 12% return. For Class B, here's an illustration of what $100,000 will look like. Remember cash flow, you'll see on the right side of year five during the whole period, we'll pay out $35,000. On the sale, right underneath there, we'll be able to pay out $53,000. So for a total of $89,000. So for $100,000 investment, we'll want to be able to give you back $189,000 for a 17% IRR and a little bit over 9% cash on cash. And then a Class C investor who comes in with 500,000, same thing, kind of the same scenario, just bigger numbers. You see the return on the right side, 179,000 cash flow during the hold period, and then net proceeds from the sales a little over 300,000, so a total of $487,000 plus your original investment of 500,000 for a little over almost an 18.5% IRR.
It's nice, very nice.
These are good numbers, yeah, absolutely, and that's why we love this deal. And then class D investors, somebody comes in with $5,000. Their return on the whole period, cash flow will be $1,578, and then 2,300 on the sale. So total of 3,887 plus your 5,000, so total 8,887 for an IRR of a little over 15%, almost 15.5%, which is still great for a small investment like that.
Yes, it is.
And sources and uses, loans going to be about 7.8 million. We're raising $4 million for this property. Purchase price is 10.75 million. We have an acquisition fee of 400,000. Then we figure about 250,000 in closing costs. We have about 100,000 in CapEx repairs, both from the bank and what we want to do as well. And then we'll have about 340,000 in reserves.
That's good.
Yeah, we got to play it safe. We have to be well capitalized.
And what did
Uh,
you say your interest rate on this is?
5.4%.
Is the owner carrying for you?
No, this is an agency. So we're doing a
Okay.
Fannie Mae loan on this one.
Okay.
Now,
They said
now,
they wouldn't carry because it doesn't meet their business plan.
yeah, not in this case. Most people won't carry. We always ask, but most of them won't. In this case, they didn't. But we got a great rate and great loan dollars. So we're happy about that.
Sure.
And then so what was done in the renovations? They actually spent $2 million in renovating the building. The exterior has all new paint. They did some roof work. They did the landscaping, the signage. They slurry sealed and restriped the parking lot. They added a basketball court. They also bought washers and dryers for the laundry rooms that are there, all smart machines, so no coin, and they're owned by the property. So that means no splits with the other revenue, oh, the other laundry companies. On the interiors, it's all new cabinets, countertops. They went with black stainless steel, black appliances, the two-tone paint, flooring, light fixtures, and then they added washers and dryers in the two bedrooms.
So let me ask you about the washer dryer, because I know a lot of different syndicators rent those out, but you don't rent them out. You put them in, but you give them, they have a card, right? They could
They
pay.
use an app. They actually use an app. So they put
They're
an app on the
actually
phone.
paying.
Yes, through the app. They pay through the app. So there's no more money to collect. Nobody's going to come and break into the machines anymore. And the money goes straight into the bank account. Super
That's,
sweet deal.
I'm telling you, that's brilliant. That's the way it needs to be. I don't,
Right.
the others are renting the machines. So they're putting the machines in and then they get a certain amount a month.
Yeah, yeah. So, people say they don't want to deal with that. I personally have owned laundromats, and since I've been buying apartment buildings, I've always put my own machines in because I don't like to split with anybody. And every time I've done that, because the revenue split's supposed to be 50-50, but every
Right.
time I've done that, my revenue triples. So I have a quick story for you. In that 150 unit building in Phoenix that we did, we remodeled the entire laundry room, took out the machines from the laundry company. We bought our own, so we spent $52,000 renovating the laundry room, adding our own smart machines, so no more money to collect. And when we were doing revenue share, we were getting about $1,000 a month on that. And I knew that 1,000 a month on 150 units was way low. And I said, okay, I'm going to take a chance. I'll spend the $50,000, redo the laundry room, and my revenue should triple. And that's according to how many, when I've done it every single time, it's always at least tripled. Well, in this case, our monthly revenue went from $1,000 a month to $4,000 a month just by buying the machines. So you can see that in a little bit over a year, we got our equipment paid for, and now it's great revenue to the bottom line, to the net operating income.
Right. So it'll take you what, a year and a half, 2 years to get those
No
machines
way,
paid off.
not even that. Way
Hmm.
less than that. Maybe like
Okay,
a year and 3 months or something like that. We'll get payback, 100% payback, and we're golden after that.
that's great. Yeah, my sister still got to go get quarters so she could go into the laundry room.
Yeah, no, we
Great.
use apps for that. So, okay, so here we go. So here's a little bit more on what they've improved. And then here's a list of what they did individually and how they spent the $2 million for that. Here's some pictures on the right side. You got some up in the center. It's the exterior pictures. Bottom center is the kitchen, and you can see where the washer and dryer is. You can see the bathroom on the upper right, and then you can see the basketball court on the lower right. You see the signage, and then you see the laundry room there on the bottom center picture, and then you can see other pictures of the exterior. Unit mix. We have 44 one bedrooms and we have 42 bedrooms. And you can kind of see what they're getting in rent, and the average rent is there. Now, here's the beauty about this project, that we've done our cost segregation study already. And that's one of the biggest things that sometimes investors look for is like, okay, what kind of tax write-off can I get into going into this investment? Did the cost segregation. We asked our tax accountants, what does that look like as far as benefit to the investors? And then they said basically it's a 44% tax write-off based on the amount of money that you invest if you're able to use it. So you have to check with your accountants on year one because of the accelerated depreciation, and that's on today's tax dollars. We have a bill in the Senate that may pass. If it passes, then they might bring back all the tax benefits. But as of right now, with the current tax laws, that's what's forecasted if you're able to use it. But you have to check with your accountants to be able to see that. And here's a little bit of wages, what the wages have been doing for the market. They've been increasing. They're forecasted to continue to increase. We like that because that gives us the ability to raise rents. Here's a little bit of employers. You got Raytheon, U of A, Banner Health. You have the Air Force Base. They're building a factory, a battery factory there, and that's forecasted to be completed in 2026, and that'll bring about 300 jobs to the area. You also have Amazon and Caterpillar.
Yeah.
Population keeps growing. It's not super fast. Tucson is more of a slower growth market, but stable. And also, there's not a lot of new product going on in Tucson. So that makes it more attractive. It's a stable market, doesn't fluctuate as much as Phoenix. Hey, here's a little bit about migration. It's still positive. So we have positive rent growth. We have good jobs. Very little new supplies. That gets us comfortable and keeps us comfortable in that market. Here's a little bit more of the market. We have market analysis here, basically saying that the average price per unit is about 140,000. Also, the median household income is about 65,000. A little bit more market analysis. Here's an aerial picture view of the complex.
Hmm.
And here's a different angle. You can see, and it's a really nice looking complex. They've done a really nice job fixing it up. Here's some rent comps. A subject is on the left. We have comps in the center and the right. These buildings, well, the big difference is some of these buildings have not been renovated. You can see our one bedroom comp is pretty much in line with what everything else is, but we have a little bit of room for the rental increase on the two bedroom. Here's another set of comps, center and right. Subject is on the left, and kind of the same scenario on the one bedrooms, same scenario, a little bit of increase on the two bedrooms. And here's a proximity map of where the comps are into the property. Now here's sales comps, and this is where it gets super interesting, is because we're paying 127,000 a door for this building. You can see the center one, it's averaging at 148,000, and then the one on the right's 181. Even though the one on the right's a little more distant, so I don't like to use it as much of a comp, but we have two more here, and the average is 141,000 a door and 143,000 a door. So we're coming in buying at about 13,000 per door discount. We're getting a great deal. We're getting the cash flow. We're getting a great loan on it, and so it just makes it for a great deal for us and for our investors. And here's a comp map of the proximity. And here's our 5-year plan. We do plan to get a supplemental loan on year three. The biggest takeaway from this, I'm not going to go through it in detail and everything else, but we have very, very conservative rental increases averaging a little bit over 2.5% on an annual basis. If the market gives us the ability to raise rents more, we will. And then the bottom of it has a sensitivity analysis, and that's fluctuation in market cap rates and how the valuation fluctuates from there. So pretty much what gets us excited about this deal is that one, it's renovated. There's no renovation risk because of tariffs. Everything is already done, and we have a little bit of room to increase in rent and being able to come back and change management companies to be able to operate a little bit more efficient. Risks, everything has a risk. We could get rent to go flat or negative. It has been flat for the last 3 years in Tucson. We know that. We do anticipate on 2026 being a year where we can create rent increases. And then we also know that the valuations of the buildings has flattened or even reduced because of the higher interest rates. We do think we're at the bottom of the market and some of these risks have been mitigated. And that's why we continue to buy in Tucson and in Phoenix, because when the market turns, when interest rates come down, when we get to a little bit of cap rate compressions and we are able to raise rents, the valuations will increase and hopefully be able to give us the exit that we're planning for, or even better. And if anybody's interested in it, you just go to our investor portal. You get in there, everything is done electronically. If you don't have a username, you create a username. You go through the docs, the PPMs, operating agreements, and then you sign the subscription agreement electronically. And once you get that done, then you get wiring instructions, you wire your money, and you're basically in the deal.
What about the crowdfunders? Do they do it the same way?
Yeah, so here's the answer to your question. This is part of the team that I've been able to put together, so you can reach me or anybody else on the team. To answer your question, is you all see our emails right underneath our emails. There's a link, and that takes you to the accredited investor portal. The bottom link, the one on the bottom, takes you to the crowdfund portal.
Ah, of course, you have it all set up. Oh,
All set up. I've done a couple of these, Peggy. I want to make sure that all the information is easy to get to.
great. Thank you. Ted,
So now,
Eric, yeah. Do you have any questions? We're almost at the top of the hour. Do you have a minute or
yeah,
how much more do you have to go through?
that's it. We're done.
Oh, okay. So Ted and Eric, do you guys have any questions? Because I already asked mine.
I've got a few.
Oh, good.
The You mentioned earlier about regulation. What do you perceive as more onerous regulations in California than in Arizona?
Okay, that's a great question. California in 2020 became a full rent control state.
Yeah.
January 1st of 2020. When they did that, and it wasn't too bad as far as what the rent control was. It was 5% plus the CPI for the area. So it could average rent increases between 8 to 10%, and that's not bad. Sometimes you couldn't give that high of an increase. What made it bad for me is that you just can't get rid of people just because. So if you have a tenant that's causing problems, you want to give them a 60-day notice to vacate, you know what? You have to go to court and you have to have a reason why you're going to vacate them. Then at that time, COVID hit, and then California protected all the land, all the tenants. Now you can't evict them. Now they don't have to pay rent, and that's troublesome. We did okay during that time, didn't really have that many issues with tenants, but because of that and having that difficulty, you can go to Arizona. In Arizona, you can evict anybody who, for any reason, you can give them one, a non-renewal. Two, if they don't pay rent, they're going to be out of there in about a month. So it's super quick. Where if you're going to do an eviction in California, it's going to take a lot longer. I don't know how long they take. I hear 3 or 4 months, 9 months. I don't do them anymore, and I've exited the California market probably about 5 years ago. So I'm not up to speed, but I do see the bills that they try to bring to come back in the city of LA. It's hard to operate as a landlord, as a property owner when you can't give the appropriate rent increases. You still have to maintain the building. Your landscapers start charging you more money. Your pool team charges you more. Your insurance goes up by a lot. Your property taxes continue to go up, and your rent doesn't keep up. That's the reason why I don't want to operate in California anymore. I mean, there's still a lot of buildings here. People still do operate and they do okay, but it's just that much easier to do it in Arizona. And Arizona's an hour away from me. I can hop on the plane and I get there in an hour. I take care of everything. I have good teams, just like I had teams out in California. I set up teams over there, and they basically are my boots on the ground and take care of everything.
Does that answer your question, Ted?
Uh, that's one. Can ask another one?
Yep.
Absolutely.
I'm curious about your attitudes relative to what your, let's say, leadership team folks should be doing besides just working. What messages do you send to them?
My leaders, the employees and the teams that work for me, what messages do I send them? Is that the question?
Mhm.
Well, here's an example, and I don't know if it's the answer that you're looking for. Our larger buildings, we get
I'm trying not to give you a leading question.
okay. So I'm going to give you the answer of how I think of what you're asking. Um, I am as a leader, I get daily daily reports from our on-site managers on the traffic, how many showings they had, how many leases they had, how many renewals they had. So we track everything on a daily basis because we need to know if we got to make a shift, we got to make it quick to maintain high occupancy. So when we get the reports that they leased something, they did renewals, we always send, hey, congratulations, thank you so much for your efforts today. And so sometimes we're sending messages back every day. So we like to show our employees and our teams that we're grateful for their help. And basically, we let them know. You can have like one of my assistants caught an email this morning and sent out a quick reply. So I reply back to them and say, hey, thank you for catching that. So I like to try to um, acknowledge the efforts that are exerted in the performance that my employees do. I don't know if that answered the
What
question, Ted.
what you're describing is what you want them to do at work. The question
Right.
was, what messages, let's say, express and implied do you send to them about what you would like them to do outside of work hours?
Okay. I don't send any messages outside of work or what they should be doing outside of work because off work hours, that's their time. And then it's not me to be able to determine that, if that answers
For
the question.
example, what sort of things do you want your CFO to be involved with professionally outside of work?
You mean like joining Rotary or Kiwanis
Yes.
or any of those kind
Or
of?
CPA Society, something like
Well,
that.
that's part of work. That's not outside of work, in my opinion.
Mm,
Yeah.
Well, I'm asking the question as open-ended as I can to see what
See what my
message it
answer
sends.
is? Outside of work, I don't tell them what to do on their personal time. No. If there's something that could potentially benefit, like an event, some type of fundraising event for work, anything that's related to work, and depending on who I think will benefit from attending, that's who I invite. But as far as them doing some charitable work or anything like that, that's not me to tell them that because they're off work hours. They're entitled to do whatever they want on their own time. And I don't know if that's answering your question or not, but I think the answer is nothing on their personal time.
See, that seems to be generally an attitude that has changed over the last 50 years or so. When when I was a young professional, the message out of the executive suite was get involved in the community. Now there is nowhere nearly that kind of encouragement, and in many cases, almost discouragement to do anything besides work, which disturbs me, frankly,
Well,
as
that
a
is work.
generality, because we're seeing a tremendous decline in, uh, let's say, the middle level executive folks in doing anything besides work because they don't get any encouragement from their leadership. Anyway, next thing. Um, how do you explain to let's say, to a tenant, what is, let's say, what cost of housing is affordable?
The 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 cost of the housing is based off what the market allows us to do.
I
So
know that's
so
what you want to charge, but how do you explain to somebody that you don't make enough money to be able to afford this?
Oh, okay. So it's real simple. There's certain guidelines that we have on each building to qualify to be able to rent. In some cases, it could be 2.5 times their income. In some cases, it could be 3 times their income, plus favorable credit report. So it's really simple. The leasing agents will basically try to qualify you. If you don't make enough, they just basically tell them you didn't qualify based on this criteria.
And then do they suggest a place that they know where they could go rent?
You know what? They work very close in the communities and they stay in contact with other building leasing agents.
Managers, yeah.
So let's just say as an example, we have one bedrooms available, but somebody shows up looking for a two-bedroom, but we don't have a two-bedroom, but they know that the building across the street or maybe down the street has two bedrooms, so they'll refer them. So they try to keep a very friendly environment between everybody so that you can help each other out.
Yeah, my sister's a manager of 40 units. They do that all the time.
Right.
Okay. This is kind of a general question that Peggy, this kind of applies to almost all the investing situations that you have. One of the things I typically don't see in real estate that I do in the securities market, uh, let's say in general, fall into the category of mutual funds in the securities market. Why doesn't there seem to be anything equivalent in the real estate market?
So what's the question?
What is it that's in the investment
In the
security market,
securities market,
real estate?
I'm sorry, in the securities market, there are vehicles called mutual funds, which enable a small investor to get
Right. That's coming.
diversification, okay, as opposed to buying, single issues, if you will. See anything, I haven't seen anything of any consequence available like that in the real estate market.
What do
Yeah, it's
you think?
called
REITs.
crowdfunding.
You have REITs. You have many REITs available, and those are all real estate based.
And those are small investments. And now we
Yeah.
have where you could diversify by buying, you could do crowdfunding and get in for $5,000 or $6,000. And then
But
there's
it's
this new one where you
still,
could,
still a single property though.
Mm, yeah. So your REITs
In
cover,
your case, your crowdfunding is for a single property.
correct. And REITs are for multiple properties.
Okay,
So
so you're saying
REITs,
REITs are the mutual funds in the real estate business.
yeah, they call
no,
them,
REITs are not mutual funds, but it's kind of, it works in the same
right.
way where it's all real estate based and it's multiple properties within the REIT.
And the other thing that's out there are called funds, where they raise $100 million of funds, and then they take that cash and go out and buy a whole bunch of different properties. They don't call themselves REITs, they call themselves funds, and they own a lot of different properties. So there is something similar. It's just not called mutual funds. It's called a bunch of different things.
Okay,
Real
thank
estate
you for
people do
letting me
not
ask some
like,
questions.
yeah, real estate people do not want to sound anything like the stock market. Because there's tax advantages in real estate. There's no tax advantages in securities. You've got property that secures you with the property in case something happens. You've got a security. If you buy an investment in the stock market, there's absolutely no security. If it goes down, you just lost your money. If it goes up, you just gained some money. There's nothing there to say you're secured. So it's the roulette table.
All right, Ted, you have another question?
No, he answered them, asked
For
them.
now, thank you.
Eric,
Okay.
do you have anything? Because we're at the top of the hour and I want to make sure all your questions we've got them all. So I don't know if Eric's there or not. Okay.
All right.
Danny, this has really been great. I will make sure that your link gets put out to everybody so they could take a look at it and ask you any questions or follow up. And then you and I need to set up a call. I have to go look these people up, but I do want to introduce you to these people because I think you will like this. This would be great for your crowdfunding people. The problem is they can't buy until after you've closed. So that doesn't really help the crowdfunders, but it can help
Right.
them if they want to buy some future. And some
Right.
people just want to get some of their money back, right? So they can move forward.
Yeah.
Yep.
Okay. Very good, Peggy.
Great. Thanks
Hey,
so much.
thank you so much. Have a wonderful day.